It's 25 quintillion bits of data a day. And every 2 years, all data doubles, whether it's now structured or unstructured. And unstructured is things like sentiment data, Snapchat, likes on Facebook, those sort of things. And of course, structured data is number type data. And it's physically impossible for any team of humans, never mind a single human, to actually process that quantity of data. So that's why AI was designed. But the problem is, if you just stop there, then you have a scenario where you have a dashboard where you can make an informed, or you can receive information on a dashboard level from AI, but then you have to make decisions and data keeps on coming in.
Like your metrics.
And that's why you need, because the humans would need to then rewrite and rewrite it. It doesn't have to do that because the machines can do that. The other point that we tend to make is, the reality is there's a challenge from a human learning perspective, the pace of human learning. I mean, it would be great if humans can actually process that fast. But I think I once read Einstein used something like 13% of his brain. And apparently we use 7 to 11% of our brains. So if we could learn faster, we probably wouldn't have needed this. But we don't have to do that on our own anymore. We have some friends of ours in the industry that have a listed ETF in the US, New York Stock Exchange. They use solely sentiment data. And then there's other people that try in Germany that has a similar usage fund to ours. They essentially try and copy what a good analyst would do, but obviously make it work faster and much more. And in our specific case, everything we do is price data driven. We don't use unstructured data. And it's a matter of pattern recognition, the evolution of the patterns, which is pretty important because capital markets don't stand still, and the prediction of the patterns, which is why you can essentially run any type of portfolio. You can run single asset, multi-asset, long only, long short, long cash, across any instrument, as long as it's liquid and has the ability to feed into the machine so the machines can learn from a pattern perspective. It's important not to think it's, because of course there's been quants, what we, as I said earlier, often call old quant. There's been quants for many, many years. And quants obviously look back, and that's why they say you never see a bad back test, you know, because by default you wouldn't if somebody released something. But it's not a matter of looking back and responding to the past. This is a question of, yes, of course it looks at old data, because you know, what is it supposed to use? But then makes a prediction. And it actually does that pretty accurately. Certainly way better than, we have a portfolio, a live portfolio, and it's actually the portfolio that's been live the longest. The intention was to create a very basic balanced type fund, equities, bonds. We actually added cash as well. And all that was done was to say, invest in the iShares S&P 500 ETF and the iShares 20-year Treasury ETF, and about a year later, cash was added as a neutral asset. So long only, 3 things, very simple. Over the last 10 years, it's done something like 340%, whereas the balanced sector itself have done about 55%. But to put it in context, and that can go from 0 to 100 in any split between those 3 things, whether it's 0, obviously, or half-half, or third, whatever it might be. I'll give you another example. Then we said, well, hang on, we've got an equity manager who's really good. In fact, his composite track record, if you go on to things like Mercer, since April 2008, is something like 245%. So it's the leading composite in the world in the global equity space. We went and put the machines over it and said, the manager picks the stocks, and the machines select when to purchase, when to sell, what the weight should be on the long side of the book, and the machines just says once a week to actually put an S&P 500 short position on, or not, or whatever the quantity might be. But again, no leverage, can't net short, that's all it does. This book of returns went from 245% to 1,200 and whatever the number was %, 5 times more essentially. So it just depends the mandate that you give the machines. Entities have 50 to 100 PhDs that come to work every day. And they have coded, they've obviously formed an ideology or a theory about world markets, capital markets. They've then gone and decided what they're going to utilize to actually display their theory. Then they go and test iterations of this. And they'll obviously launch the optimal, which is why, again, as I said earlier, people say you never see a bad backtest, because why would you launch a bad one? But they go and launch the optimal one on the basis that they can more or less expect the future to look the same. The problem is maybe in the long term, potentially in the medium term, the future could look the same for periods of time. But capital markets evolve, and actually they've changed a lot since central banks got involved and started buying equities and the likes, and obviously printing loads of money. The difference here is those 50 to 100 PhDs come to work every day. They look for new patterns. When they identify new patterns, they as humans test them and rewrite the code, and it's fixed again. Now, even though that is quite incredible versus just discretionary management, and they've had various outcomes, obviously, in this case, you have machines that learn all the time, look for patterns all the time, recognize it themselves, write their own models, and rewrite their own algorithms. That a lot of the economic theory and a lot of the portfolio compositioning theory we've been taught by very famous names who won Nobel Prizes for it just simply doesn't work anymore. Doesn't mean that they did was wrong. In fact, long ago, Japanese equities behaved differently from US equities. Then equities started correlating, and then people started putting different asset classes together. Obviously, initially it was a matter of putting bonds and equities together, and then it's evolved to property and different commodities, and now people say hedge funds is an asset class, which it's obviously not, but from an alternative asset or strategy perspective that behaves differently, to put that into a portfolio. The problem, though, is the world has become completely correlated now. When things go wrong, everything tends to go wrong. I have a slide that I often use in presentations where I just take the MSCI World, Developed Market Equities, and the Barclays Global Aggregate Bond Index, probably the most well-known bond index. Their correlation 10 years leading up to September 2008 was negative 0.21%. Perfect. I want loads of those things in my portfolio. And in those 4 months from September to December 2008, they essentially became completely 0.97 correlated. And then since the market started going up on the 6th of March 2009 again, it's dropped down to, I think it's 0.23%. So they've become less correlated again, not negative. But I would bet the house that essentially they'll become completely correlated again in the next crash. So you've got a scenario where the world has changed. We've become globalized. People trade all around the world. Those things don't really work anymore. And it already proved itself in the financial crisis. There's a couple of things like treasuries did well, gold did fine, Swiss government bonds did well. But then again, Swissy is a bit of the Swiss franc is a bit of a proxy sometimes for gold. But it's been an incredible experience because it's obviously very unique. It is the future. I think most people recognize that, and it's not a matter of us recognizing it. You will read things like, the CEO of Google saying machine learning is the future. Forbes stating that if you are a CEO and you're not utilizing AI or planning to use AI in your business, you will fall behind. These are pretty strong statements. It was either E&Y or KPMG that produced a report recently that said they expect AI to contribute something like 17%, or it's either 15% or 17%, which is the equivalent of either 15 or 17 trillion dollars to the global economy by 2030. It's here to stay. It's not a question of is it coming, it's here. We all use it every day anyway. Our mobile phones, the way we shop, the way we watch TV, soon the way we're going to drive cars, etc., etc. Yes. From an investment manager perspective, I don't think it's a challenge. I think it's something that should be embraced. Because if you have something that can make you better and function better, humans are incredibly creative things, and obviously have potential beyond it's humans after all that built all of this in the first place. So, we have a statement, and it's not us that came up with it. It was the CEO of IBM that said, it's not a question of man versus machine. It's a matter of man with machine, instead of man on its own. And we've certainly embraced it. We'll embrace it more, and I have no doubt the industry will embrace it in time because it just makes you so much more efficient in what you do. From an investor perspective, I think it's a perceptual exercise. There's a lot about AI at the moment, which is why the investment management side, the banking side, and even the consumer side from a business perspective already is familiar with all of this, or to a great extent. But investors, they don't even understand normal investment management. But the difference is they don't understand it, and they get really angry when things go wrong, obviously, rightly so. They tend to not really ask too many questions when things go right. But I think at this stage it's a question of people just fearing the unknown and thinking, what can this do? It can't do crazy things. It can only do what you confine it to do. It can't just, machines don't come to work on a day and say, hey, today I'm going to leverage the S&P 500 10 times. It cannot do that. It can only do what you allow it to do. In fact, this bit where machines supposedly do crazy things, it's probably a result of things like the Terminator. movies done by Hollywood of general intelligence, it's called. And if that happens one day, they'll call that supposedly super intelligence. But at the moment, neither the software or the hardware even exists to be able to do that. So we've got narrow intelligence, our phones, and many, many other things we use on a daily basis. I think at this stage, it's a matter of investors, they like listening to a human talk. They like the chief economist of a company, or the chief investment officer, or the portfolio manager talk about their opinion of the world and what they think is going to happen. Of course, because we're human. And you know, how much validity that have in the next 24 hours, in the next month, in the next year. Of course, the further you go, these economic theories play out, because that's why they exist in the first place, or most of them play out, I should say. But I think people just, that ability to talk to machines, or ask it, why did you do what you did? Those are literally the two obstacles or hurdles or challenges that I see at the moment for people to get comfort. As soon as you get either a human that can relay the message because they can open something up and give an opinion on the back of that, or the machines themselves to somehow at the one point, and this is across AI and machine learning, it's the same thing, to be able to say, you can ask it a question, like Sophia, if you've seen Sophia, exactly, the humanoid, that's quite interesting. But I think those are the two challenges at this stage that I can see. In terms of risk management, in terms of capital loss management, and making more money, I'm yet to see something that disappoints me. The volatility to capital loss is about 3 to 4 times worse capital loss. So the client thinks they've communicated their willingness to lose, say, 10%. And then what happened in the financial crisis, the market dropped 35% for those type of portfolios. And the client obviously never expected that. And that's where the breakdown in relationship takes place and the loss of trust. And the machines help bring that significantly closer, those two numbers. So I think this will actually help reestablish trust in financial services, which is ultimately what we need, because people need to save for retirement. Otherwise, who's going to look after them?